Record profits, record buybacks, record layoffs. In the old world of economics, this combination was a paradox, a sign of corporate crisis. Today, it's a quarterly strategy. It's financial hygiene. When a profitable company fires 5,000 people, they aren't telling you they're in trouble. They are sending a coded message to Wall Street. They are saying, "We have stopped chasing the future, and we have started harvesting the present." Today, we go behind the balance sheet to understand the year of efficiency. Why the era of free money created a human debt, and why, in a high-interest world, you are no longer an asset. You are an interest-bearing liability. Part 1. The death of the story stock. For a decade, money was essentially free. When interest rates are zero, the future is cheap to buy. Companies hired tens of thousands of people for projects that might not pay off for 10 years. It didn't matter. Investors paid for the story. But when central banks hiked rates to 5%, the math changed. Suddenly, $1 10 years from now is worth significantly less today. This is the discount rate in action. Investors stopped asking, "How big can you grow?" and started asking, "How much can you squeeze?" Payroll is the largest variable cost on a balance sheet. To a CEO, a layoff isn't a tragedy. It's a repricing event. It's the sound of a company shrinking itself to fit a smaller, more expensive world. Part 2. Labor became a balance sheet variable. Most people still think of employment as a relationship. Companies increasingly treat it as exposure. Payroll is a recurring commitment. It behaves like a subscription you can't cancel quietly. But once the norm shifts, cancellation becomes normal too. In a slow-growth world, markets reward operating leverage. Revenue up, headcount flat, or revenue flat, headcount down. Margins become the hero metric, so layoffs turn into a signal, not just a cost action, a messaging action. There's also a timing issue. Layoffs are forward-looking. Companies cut based on what they fear, not what already happened. If leadership expects demand to cool, regulation to tighten, or financing to get harder, they cut early. It's cheaper than waiting. And there's a quiet incentive problem hiding underneath. Executives are judged in quarters. Teams are built over years. When those clocks collide, labor loses. This is the paradox people feel but struggle to explain. Profits can look strong today, but if tomorrow feels riskier, companies de-risk payroll. That's the modern pattern. Part 3. The efficiency ritual. Look at Mark Zuckerberg's year of efficiency. Meta didn't cut staff because the metaverse failed. They cut staff because the market demanded a sacrificial lamb to the altar of margins. Notice the pattern. Amazon, Google, Microsoft. They all used the same language, reallocating resources, flattening the org. This isn't management, it's financial engineering. By removing middle management, they increase the span of control. They are betting that AI and automation can bridge the gap. They are turning the firm from a growing organism into a lean cash machine. Part 4. The productivity illusion. Now we hit the most uncomfortable part. The belief that fewer people can do the same work. Sometimes it's real. Software improved. Automation expanded. AI compressed certain workflows. But there's a trap here. Short-term productivity can be borrowed from the future. You cut staff. Output stays stable for a while. It looks like efficiency. But buffers shrink. Support weakens. Institutional memory leaks out. So the real question isn't, can we do more with less? It's, how long can we do it before something breaks? Lean companies are fast, but they're also brittle, and AI adds a new twist. In many firms, AI doesn't replace entire jobs. It compresses workflows. Drafting, analysis, reporting, customer responses. That makes junior layers vulnerable, and over time, middle layers too. Not because they're useless, but because companies are hunting for span of control. Fewer managers, fewer coordinators, more direct lines. The productivity story has two versions, one optimistic, one darker. Both can be true. Part 5. Risk management, not growth. Even without AI, risk is doing a lot of work here. The world became more volatile. Supply chains are fragile. Energy shocks happen. Geopolitics adds uncertainty. Regulation moves faster. In that environment, companies optimize for survivability. They want optionality. They want flexibility. They want a cost base that can shrink quickly. Payroll becomes the shock absorber. There's also a financing angle. Companies with debt feel higher interest costs over time. Refinancing gets expensive. Protecting cash turns into strategy. That's why layoffs happen even when profits are fine. Profits are a snapshot. Risk is a forecast, and markets reward forecasts. If a CEO convinces investors the company is becoming leaner and more resilient, the stock can rise. That creates a feedback loop. Layoffs stop being tolerated. They become incentivized. Part 6. What this means for workers. So what does this mean on the human side? It means insecurity becomes structural. Not because managers became cruel, but because the system became liquid. Employment starts to look less like marriage, more like a contract that can be rewritten when rates change. Identity shifts too. People used to anchor their lives around a stable employer. Now employers manage headcount like inventory, and inventory is always adjustable. This isn't a call for outrage. It's a call for clarity. In this system, loyalty isn't a guarantee. Competence isn't a guarantee. Timing matters, rates matter, investor narratives matter. Stability moved away from people and onto balance sheets. Most people won't experience this shift as a single dramatic moment. There won't be one email, one meeting, one clear signal. It shows up quietly, in smaller teams, in wider job scopes, in fewer safety nets. In roles that feel temporary even when the contract says permanent. That's how structural change usually works, not as a crash, but as a slow normalization. The social contract of the 20th century is officially dead. Employment used to be a marriage, now it's a liquid contract. The paradox of the profitable layoff tells us one thing: stability is now treated as a cost that must be optimized. In this system, your competence isn't a guarantee of safety. Your loyalty isn't a hedge against a rate hike. We've built an economy where the balance sheet is protected at all costs, while the people on it are treated like just-in-time inventory. Stay curious, stay sharp.